Good morning. Today we are going to review GBP USD that's actually just received mixed UK jobs data. Unemployment just hit its highest level since 2021, and firms are cutting jobs at the fastest pace in years. But sterling is holding firm and pushing towards the 135 handle. Why? Because wage growth remains sticky at 4.7, which keeps, of course, the Bank of England, I wouldn't say hawkish, but at least they wouldn't want to cut. While at the same time, renewed tariff threats from President Trump are weighing on the US dollar. So let's break it down. So we had a 43,000 drop in payrolls for December, which is double what the market expected. Okay, normally this would crush the pound, but wage growth held at 4.7. Sticky inflation sort of rhetoric means that traders barely moved their BOE rate cut expectations. Okay, and the market sees little chance of a cut in the coming months now, which is what is supporting sterling, alongside, of course, geopolitical tensions. On the other half of the equation, of course, is the weaker dollar. As I said, over the weekend, we know what happened with Trump. He's threatened new tariffs on 8 European nations, including the UK, of course, if the US isn't permitted to buy Greenland. So this is pressuring greenback and helping lift the GBP USD. Now we have, of course, to watch Davos to see what's going on. Okay, and most importantly for the pound, also have to keep an eye on the CPI inflation data tomorrow. More important than jobs, I would say, because it will tell us whether the move, whatever that ends to be at the end of the day, continues or not. So on the 4 hours here, we see that, to me at least, this looks some sort of like a flag pattern, guys. Okay, so breaking this trend line, and we are shooting higher towards 135. So there is a few things to do. First of all, we need to get our Fibonacci tool out and see why. What doesn't let us move higher? And it's the 61.8 Fibonacci. What doesn't let us move higher? Okay, so this is support now. It doesn't mean that this isn't. This also is support. Didn't reach there yet, but I don't think it makes much difference, to be fair. What we do see currently, potentially, right, if that indeed is a support, resistance, excuse me, because the RSI is also nearly overbought. Last time around, supposedly, we didn't really turn around at above the 70 line, so not a problem over here for us to go over it, right? So we could face a double top. Now, a double top could come back down here and shoot higher because it would give us potentially an inverse head and shoulders. But also it could mean that we're going to decelerate further down. Okay. On the other hand, if this move continues with, of course, hawkish CPI data tomorrow, then we'll be looking for the 100 Fibonacci extension next, which is at 135, also psychological handle. And then above that, you have the 138.2 on 35.42 and a cluster. The 161.8 Fibonacci extension comes exactly at the previous peak on seen in January 6th. Okay, so this is a very good indication of a orthodox market, let's just say, right? So these are my Fibonacci extension levels and targets to the upside, okay, in case we do break above that level. So for me, I would be looking to long this, and I will tell you why, around the 50%. Yeah, with first target at the 100, then 138, then the 100, and put a stop loss just below the 23.6. Okay, still a good risk reward trade overall. Why below that level? Because we would still trade the inverse head and shoulders if we came down all that way to the previous swing low. Now, why wait for the correction, you might ask? First of all, we'll have a double top. Second, it is likely we'll get the 135 and then start correcting. But most importantly, because when we're looking at the Fibonacci extension in this particular pattern, at least to the upside, we're looking for a potential impulse. An impulse means that this is probably wave one and then wave two. and then we're going to get a wave 3. Whether it goes up or not, it doesn't matter. Then a wave 4, okay, and then a wave 5. Another way to do this, perhaps even better, because currently we would need perhaps this is the first and the second, the third would ideally have to be bigger than the first. It means that our 100 target would be from the low here up to 135. So we ideally want that leg to go above 135. Okay. If we went above 135, then we're going to place our entry at the 61.8 Fibonacci extension. Okay. Is that clear? If we move to 135, the entry should be a little bit higher at 0.61.8. If we do a double top here, then the entry could be at 50, but I will be more cautious with the stop loss. I will probably keep it tighter, okay, and how high this can go, because without that wave being larger than the first, the chances of an impulse are going to decrease, okay. The good thing is that this is a very shallow move as well, okay, and the RSI still gives us move to the upside, but this double top is what is the current concern. Okay, so if we break through, again, we're looking at a new multi-month high potentially, okay? But if, well, the dollar reverses because of geopolitics and Davos, Trump's speech, or the CPI fails to kind of, improve the current sentiment today, a failure could see us rotate, back towards the 133.40, I would say. Okay, so let me know in the comments, are you buying the breakout, potential breakout of 135 or to 135, or worried about the unemployment, the inflation, or Trump? Either way, trade safe.